Welcome to the TAC Index AI podcast, December 11th, 2025, where we blend TAC IP data reports and charts with the latest news and all things logistics with a focus on air cargo. Okay, let's unpack this deep dive. Our mission today is to connect this week's critical air cargo data from TAC Index directly to the wider logistics and macro market picture. And the big takeaway we see right up front is this real tension. The peak season surge is defying expectations, but it's running headlong into a capacity wall. It's becoming, well, structural.
What's fascinating here is just the sheer velocity of the market spike. I mean, this isn't some cautious recovery.
No.
This is strong, undeniable demand driving rates up and fast.
Right.
We need to look at where this surge is concentrated and, immediately connect that to the bottlenecks in aircraft deliveries.
Right. Let's get into the numbers because they tell a powerful story. The global Baltic Air Freight Index, the BAI 0, that's the worldwide benchmark.
Yeah.
It gained a chunky plus 6.5% week over week through December 8th. It is absolutely heading toward that typical peak season crescendo.
But it's still down year over year, just slightly.
Exactly, just slightly. But the momentum is huge. So is this game uniform across the board?
Not at all.
Yeah.
And this is where it gets nuanced. You have to focus on the regional hubs. Outbound Shanghai, the BAI 80, is the current powerhouse.
Okay.
It saw a massive gain of 7.7% WOW, and crucially, it's now up 6.6% year over year.
So Shanghai has actually exceeded its last peak season high.
It has. Now, compare that to Hong Kong, the BAI 30, where rates are starting to level off. It really suggests Shanghai is bearing the brunt of this global rush.
So if Asia is the supply engine, how are demand points like North America reacting? We saw something spectacular out of the U.S.
Oh, Chicago?
Exactly. Rates out of Chicago, the BAI 50, bounced sharply. I mean, they surged a dramatic 46.7%. Wow, that's more than just a holiday bounce.
Right, that's shippers paying massive premiums to recover lost time after Thanksgiving and those recent weather disruptions. It's a sign of real desperation.
And that desperation brings us right to the capacity issue.
It does. If you connect this demand surge to the bigger operational picture, you find a real paradox. IATA is projecting global airlines will hit a record $41 billion in net profit next year.
$41 billion? Wow.
A record. Yet they note this profitability is being severely constrained by ongoing supply chain failures and just chronically slow aircraft deliveries.
Wait, so hang on. Even with record profits on the horizon, the manufacturers are effectively the bottleneck to the airline's own success.
That's it exactly. And you see that constraint playing out geopolitically. Airbus did secure clearance from China to deliver 120 previously ordered jets.
Which is good news.
It is, but the bigger story is the potential new order for 500 jets that's still stalled. That stall is precisely why IATA noted that confidence in the Airbus delivery pipeline is weakening.
And it's not just geopolitics, it's quality control as well, right?
Precisely. That weakened confidence is also linked to quality issues. Things like, fuselage panel defects, recent software glitches. So fewer new fuel-efficient aircraft are coming online.
Which forces carriers to rely on older jets.
And that directly increases the cost and scarcity and therefore the value of the current air cargo capacity.
Okay, so let's zoom out. What does this all mean for the financial and operational backdrop?
Two key forces.
First, fuel costs are on the rise. Brent crude settled higher at $62.21 a barrel after the U.S. seized an oil tanker off Venezuela.
And that geopolitical tension plus a drop in U.S. inventories pushes input costs higher for everyone. It especially hurts when you're flying those older, less fuel-efficient jets we just mentioned.
Good point. And then on the finance side.
The Federal Reserve cut interest rates by 1/4 point. Crucially, the move was seen as less hawkish than expected.
Meaning they signaled they won't be as aggressive with future hikes.
Exactly. So the dollar slid, stocks jumped, and it created this. Let's call it a cautiously favorable backdrop for global trade. So if you're planning capacity right now, the key takeaway is that air freight is in a perfect storm. You have surging seasonal demand layered right on top of these deep structural capacity constraints.
From the delayed planes and the manufacturer uncertainty.
Right. This strong pricing momentum signals resilience, for sure, but also a real vulnerability in the global supply chain's infrastructure.
So think about that tension-strong short-term demand versus weak long-term aircraft delivery confidence. And think about how that's going to keep trans-Pacific spot rates surprisingly firm in Q1 2026, long after this peak season dust typically settles. Until next time.